Quick question. Who owns your house right now? Not in 5 years, not when you pay it off, not in theory, right now, today. If your answer was anything other than the bank, this video is going to be uncomfortable because I'm going to show you exactly how much the bank has already made off you. The number is going to be specific and it's going to be ugly. Let's start with a number most people never look up. $480,000 mortgage, 30 years, 7.5%. The Freddie Mac average right now. Total interest paid over the life of that loan, $728,520, not the purchase price, not the principal, just the interest, just the bank's cut. $728,520 delivered to the bank in silence. $3,257 at a time, every single month for 30 years. But let's make it more personal than that. Let's talk about the first 12 years. You make your payment every month. You never miss. You set up autopay. You're responsible. You're doing everything right. After 12 years, total amount you've paid, $483,384. Now here's the question nobody asks at the closing table. How much did that $483,384 actually reduce your loan balance? $89,400. You paid $483,384. Your balance went down $89,400. The other $393,284's gone, straight to the bank. In interest, 12 years of work, 12 years of alarm clocks, 12 years of not missing a single payment, and you still owe nearly what you started with. That's not a mortgage. That's a golden egg machine. And you're not the one collecting the eggs. Meet Tom, 51 years old, bought his house in 2013 for $320,000, financed $256,000 at 4.5%. Felt smart, felt stable, felt like he'd made it. And then 2020 happened. Rates dropped. His loan officer called. Tom, I can get you down to 3.1%. Your monthly payment drops $200? It's a no-brainer. Tom refinanced. New loan, $231,000. New rate, 3.1%. New term, 30 years. Tom thought he was winning. Here's what actually happened. Every refinance resets the amortization clock, back to year one, back to the part of the loan where almost everything goes to interest and almost nothing reduces the balance. Tom didn't outsmart the system. Tom handed the bank a brand new 30-year contract just when the old one was finally starting to work in his favor. The loan officer got a commission. The bank got a new mortgage. Tom got a slightly lower monthly payment and another 3 decades on the hook. Today, Tom is 51. He owes $198,000. The bank has already collected $187,000 in interest from him across 2 loans. Tom posts a photo of his house every Thanksgiving. Grateful for this home. Blessed. The bank is grateful too. More grateful than Tom will ever know. And here's the part that should stop you cold. Tom has no idea who actually owns his mortgage right now because the bank that originated his loan sold it within 90 days of closing to Fannie Mae or Freddie Mac or a mortgage-backed security held by investors Tom has never heard of in cities Tom has never visited. Tom makes his payment every month to a servicer, a middleman, while the actual debt was packaged, bundled, and sold on the secondary market before Tom had even changed the locks. Tom thinks he has a relationship with his bank. His bank thinks he's a revenue stream. There's a difference. Here's the architecture. The 30-year amortizing mortgage was not designed in 1934 to help American families build wealth. It was designed by the Federal Housing Administration to maximize bank liquidity. Front-loaded interest is not an accident. It is a feature. In the first year of a $480,000 mortgage at 7.5%, your monthly payment is $3,257. Of that, $3,000 goes to interest. $357 reduces your balance. You are paying the bank $3,000 to borrow money you already owe them every single month for years. Before the ratio meaningfully shifts, and the refinance trap is the most elegant part of the system. When rates drop, and they will drop, they always eventually drop, the bank's marketing machine activates. Loan officers call, mailers arrive, Online calculators show you how much you'll save every month. What they don't show you, the interest you already paid on the old loan that you will never recover. The new 30-year clock that just started ticking. The thousands of dollars in closing costs rolled quietly into the new balance. The bank doesn't lose when you refinance. The bank wins twice. Once on the loan you're leaving, once on the loan you're starting. And here's the detail that should make your jaw tighten. Banks sell your mortgage on the secondary market within weeks of closing. They collect the origination fee, they collect the closing costs, they sell the loan to investors, and they move on to the next golden goose. You spend 30 years feeling loyal to an institution that stopped holding your loan before your first payment was due. The sheep watches the monthly payment, refinances when the rate drops, celebrates the lower number, resets the clock, starts over, does it again, feels smart every time, loses ground every time. The wolf watches one number only, the principal balance. Because here is the math that changes everything. Every extra dollar applied to principal today eliminates multiple dollars of future interest. On a $480,000 mortgage at 7.5%, an extra $200 per month applied to principal from day one saves $89,000 in interest and cuts 7 years off the loan. 7 years. $89,000 for $200 a month. There is no investment available to you with zero risk that returns the equivalent of your mortgage interest rate. Paying down principal is the guaranteed return nobody talks about because nobody profits when you do it. Your financial advisor doesn't get a commission when you pay down your mortgage. Your bank doesn't send you a congratulations card when your balance drops faster than scheduled. The wolf doesn't need their permission or their approval to understand where the real return is. The sheep asks, "How low can I get my monthly payment?" The wolf asks, "How fast can I eliminate this balance?" That's the entire difference between being the farmer and being the goose. 3 moves. Start today. Step 1. Open the statement. Look at the real number, not the monthly payment, the current principal balance. Now pull up your original loan amount. Calculate the difference. That gap between what you've paid in total and how much your balance actually dropped is what the bank has already collected from you. Most people have never done this calculation because the people who profit from your mortgage have no interest in making it easy to see. See it, feel it, let it make you angry. Anger is useful here. Step 2. Never refinance to extend your term. If rates drop and you refinance, refinance to a shorter term. Or keep your current payment amount and apply the difference to principal. Never reset 30 years. Never start the amortization clock over just because a loan officer told you your monthly payment would go down. Lower payment, longer sentence. That's the trade they're offering. Read it clearly before you sign. Step 3. Attack the principal. Every month, whatever you can add, $50, $100, $200, $500 applied directly to principal. Not to the next payment, to the principal balance. Specify this in writing, because servicers have been known to apply extra payments to future interest unless you explicitly instruct otherwise. Every dollar you put into that balance today returns the equivalent of your interest rate. Guaranteed. No market risk, no volatility, no counterparty. The bank designed this system to make sure you never think about it. Think about it. Tom is going to post that Thanksgiving photo again, grateful for this home. And the bank, whoever actually holds his mortgage this year, is going to be grateful too, for the interest, for the reset clock, for the 30 years of payments still ahead of him at 51 years old. You've seen the architecture now. You know how the amortization works. You know what refinancing really costs. You know who's been collecting the eggs. The question is simple. Are you the farmer or are you the goose? Comment farmer below. Because now you know exactly who's been sitting at the other end of every payment you've ever made.